So let's unpack that and the reason that the Reserve Bank decided to go this route. We've got Chief Economist at Stanlib, Kevin Lings, who joins us this evening. Kevin, as always, thank you very much for your time this evening. And I think the big question that everybody's wondering now is why is it that when many analysts and economists, those that were polled, said that we were probably going to get a 25 basis point increase, did the SARB turn around and give us a 50 basis points increase today? What is their reasoning?
I'd like to know myself. I heard Sally ask, can you ask the economist to explain why this is a good idea? The economist can't explain why it's a great idea. In essence, what the Reserve Bank, I guess, is saying is that inflation in the last data was worse. Absolutely, it was worse. There's also evidence that inflation has broadened out. There are more categories that are showing inflationary pressure. At one point, it was confined much more to the energy sector, food inflation, but there's no doubt that it has broadened out. And I guess in addition to that, you've got some other pressure points, and that is when companies are putting in renewable energy projects, solar projects, that's quite a large cost for that company, and there is some evidence that companies are passing those costs on ultimately to the consumer. Now, we've seen that a little bit in the food sector, and that's partly why food inflation is up at 14%. But I think the Reserve Bank is concerned that you're going to see that happen elsewhere in the economy, and therefore you'll get a further broadening out of inflation. Now, if you look at their forecast, they're forecasting inflation this year to average essentially 6%. Ultimately, their target is 4.5. It's not really 3 to 6. Their target is to get it to the midpoint, 4.5. And what they're saying is that it's at this stage, it doesn't look likely that it's going to get there anytime soon. And so they obviously feel they need to be more aggressive in terms of the interest rate in order to discourage companies from passing on more of these costs and absorb more of that cost pressure. Whether it will work, obviously, we have to wait and see. But I think that's some of the rationale for the hike.
Yeah. Kevin, in his Q&A session after that official address, the governor was asked about when do we reach the top of the ceiling? And the governor was very honest to say, well, we don't know. There's so many moving parts, so we can't say that we've got 2 more hikes or 1 more hike. And that's, for a consumer watching or listening in, is very concerning because it means this could be indefinite, the increases. And what are your thoughts on that?
So it's very troubling for consumers because in order to plan, in order to budget, in order to work out whether you can afford the house, the car, etc., then you want to see where interest rates might well end up. And the fact that they have accelerated the interest rate hike tells you that this is probably not the last of the interest rates. It would be very unusual to accelerate rate hikes and then suddenly stop entirely and see no more rate increases. How many further rate hikes, that's difficult to judge. And I think the governor's been honest. They don't know. A lot's going to depend on what happens internationally. There's been significant events that have disturbed markets. What happens to the price pressure domestically? We've got this big electricity price increase coming through in the middle of the year. Does that add to the pressure and help to broaden out the overall pricing in South Africa? Difficult. We've got wage increases that are some wage increases are going up above 6%. That could feed into further inflationary pressure. We've got a currency that has weakened considerably when you look at it this time last year. Difficult to put all of that together and say this is absolutely the top of the interest rate cycle. I think the best you can say is I think we're close to the top. I don't think we're in for significantly for more rate. But the message from the Reserve Bank is they're adamant. They are absolutely adamant. They want to get inflation down. And they want it at 4.5%. And I think that's the message that we've got to take on board. And they're going to do what's necessary to achieve that. And ultimately, that's good for South Africa. So you've got to see this as short-term pain for long-term gain. It's necessary that you keep inflation under control for the benefit of the broader economy.
Yeah, hopefully that gain will be coming soon, Kevin. A final thought from you. It was quite interesting when he said that load shedding contributed 0.5% to overall inflation. And because the energy crisis doesn't look like it's going to be leaving us any soon, this is something that's going to keep the SARB under pressure when it comes to the difficult decision of the short-term pain that you've just described to us.
Absolutely. So think about the load shedding that the Reserve Bank is now indicating is affecting the economy. So you're right, there's a cost implication. In other words, there's a pricing or an inflation implication because load shedding adds to the complexity of doing business. It adds to the cost of business doing. It adds to the delay in getting goods. So there's a short supply of goods because companies can't operate effectively. So there's a layer of cost. Think of it as a layer of decreased productivity, and that somebody has to absorb that cost, and potentially it's the consumer, so there is an inflationary impact. And the second is that in the latest number, the Reserve Bank has only got growth of 0.2% for this year, and they've just increased interest rates. And a lot of that 0.2% is the extent of load shedding. So load shedding is doing two really horrible things to us. It's weakening the economy and it's raising prices, and the combination is dreadful for most households.
Absolutely. Reserve Bank indicating that load shedding actually wiped off about 2.2% of potential economic growth that we would have seen this year. Thank you very much, Kevin Lings. He's the chief economist at Stanlib, trying to break down why it is necessary for the SARB to take the route that they have taken in today's meeting. And that's all.